everyone, and welcome back to Accounting 1310, where we're continuing upon our current liabilities discussion. So now we have some payroll costs because one of the most expensive things to a company is paying your employees, right? And I think what us as employees don't always understand is the actual cost to our employer is much more than just our salary. Okay, so employees and employers both have expenses that they have to pay. So what do the employees have to pay? Well, you and I, right? Well, we got to pay taxes, income taxes specifically. So it's always kind of a disappointing experience when you get your paycheck. You're like, well, I took my salary and divided it by 12. And then you get significantly less than that because you have taxes that are being withheld, right? The U.S. government requires that we that we pay income tax. Beyond just income tax, we also pay something that is collectively called FICA tax, which is Social Security and Medicare tax. So Social Security, I believe, is I should know this off the top of my head because I know FICA total is 5.65%, I want to say. Which is coming primarily from Social Security, and that's 6.2%, and your Medicare, which is 1.45%. We're going to fact check that on a slide in a little bit, but we have to pay that portion of the FICA tax. We also have contributions for health, dental, disability, and life insurance, right? If we have insurance, that's withheld from our paycheck. And then we also hopefully are retiring or investing in our retirement, our 401k. Those are all things that are just withheld from our paycheck. We never see it. Now, the employer has to pay federal and state unemployment tax. Okay, so employer pays unemployment taxes. Notice the second point. Hey, both parties pay this FICA tax. So not only does the employee pay 7.65%, the employer also pays an additional 7.65%. So that's a cost to both of us. The employer, typically, that's part of a benefit package, is you're like, hey, come work for me. I'm going to help cover a lot of your insurance. And also, I might match some 401k contributions. Okay. So if you're looking at this kind of zoomed in a little bit, right? Oh, see, I was right. This is great. I have my stated income tax. This is going to really depend on the tax bracket that you're in, right? You know, if you want to go look, the IRS changes their brackets every year to index for inflation, but you can go see the amount of taxes that you're going to pay. You have your 7.65% collectively with FICA, anything withheld for insurance, and then retirement. Employers, okay, we have the additional FICA tax, their unemployment tax, and then again, we call these bennies or French, or not French, oh my gosh, fringe benefits here. So, you know, that's part of the benefit of having a full-time job is you have benefits beyond just a salary. So how does that look from an accounting standpoint? Well, let's do this example of Hawaiian agency or travel agency has total payroll for the month of January of $100,000 for its 20 employees. Okay. And I have all of these different information pieces. So I have income taxes withheld. I have my FICA. I have health insurance premiums that's paid by the employer, contributions paid by the employer to my retirement. I got some unemployment. And I got to understand, right, what exactly is actually going on. So in our first journal entry here, what we're going to do is you're always going to start with a salaries expense. Okay. Because we have 3 different journal entries for these. And the first one is for salaries expense. And that's going to be the total that's given to me up here. So I'm going to say my salaries expense is increasing by that $100,000. That's my debit balance. I'm going to hold that there. Okay. Now I need to ask myself, well, what is the employee responsible for here? Right? What is the employee responsible for? Well, the employee is responsible for paying income tax. So the employer is booking a journal entry and saying, hey, I have this employee income tax payable. okay, that I'm holding on to this $24,000 for these employees, and that's going to be remitted to the U.S. government. So it's a liability on the employer's books until they actually pay the U.S. government on behalf of their employee. Okay. What else does the employee pay? What are they kind of, responsible for? Well, we know they're responsible for some portion or a portion, right? 7.65% of FICA tax. So I'm going to say I have my FICA tax payable. Okay. How do I calculate that? Well, I have my $100,000 in total salaries expense multiplied by 7.65%. That's going to give me $7,650. So now, okay, I have accounted for, as the employer, I've withheld their taxes and I've withheld FICA tax. Now, all I do is I plug what is called salaries payable. Okay, I plug it. I just make this balance. I make my debits equal my credits. Because, hey, right, this is what's actually going to be distributed in my in my employee's paycheck. Right. So I'm holding on to these two things that I'm going to ultimately remit on my employee's behalf. It's a liability to me as the company, until I actually pay that cash. So I'll go back super quick. We're just looking at the employee portion over here. These last three, paid by employer, and my unemployment tax, well, that's all stuff that the employer takes care of. So my first journal entry is always my employee. So make sure you don't try to combine any of these things, okay? Because now this next journal entry is when I start looking at my employer provided fringe benefits, okay? So let's see here. How do we go about doing something like this? Again, I go and I say employee is responsible for that. Employer and employee are responsible for FICA taxes. But I don't think FICA tax is really a benefit, right? It's just a tax that they have to pay. But now onto my health insurance premiums and my retirement plans. Well, and those sound like benefits to me, okay? So as the employer, I'm going to recognize an additional, right, excuse me, salaries expense for the amount of my fringe benefits. Well, what fringe benefits do I offer? Well, I have fringe benefits payable related to what? Blue Cross. And I have fringe benefits payable related to Fidelity for my retirement. So I have $5,000 to Blue Cross, $10,000 to Fidelity. Well, now to make my journal entry balance, I got $15,000 of additional salaries expense. So, I mean, really think about that just from a personal perspective, okay? You're like, hey, I have this total salary, right? This is what the company says they're going to pay me. There's another $15,000 related to your salary on the back end that is a different form of compensation, right? Like, sure, you're not getting money or cash for it, but it definitely has value because you're getting insurance, okay? So first journal entry is the employee withholdings. Second journal entry is the employer fringe benefits. And the third journal entry is going to be my employer's payroll tax. So what do we have left that I haven't considered? Well, I know this is my employee. Okay, wait a second. I know that the employer has a matching 7.65% on their total FICA tax because the employer and the employee pays it. So I need to establish a FICA tax payable, right? And it's always going to equal the same amount. It's going to be my $100,000 in total salaries expense multiplied by my 7.65% FICA rate. So this will always be the same between the employer and the employee. Your FICA tax payable, they need to equal because they're always going to be based off of the same number, okay? Now, I took care of my fringe bennies on the last slide, but here I have that unemployment tax, and I know that the employer pays unemployment tax. So I'm going to have an unemployment tax payable, right, for the amount of 6% on the $100,000 of salaries that I have. So I have $6,000 in unemployment tax payable. So now, instead of calling it salaries expense, I'm going to be a little bit more specific here. And I'm going to say I have payroll tax expense. And again, the reason that I do that is just to give a little bit of clarity as to what these different expenses are for. So I have 13,650 related to payroll taxes, okay? In addition to, hey, the salaries that I'm paying you, hey, the benefits that I'm giving you, well, now I have additional taxes as an employee, okay? So employee salaries are reduced by the withholding for federal and state income tax, FICA, and the employee portion of insurance and retirement. The employer, right, they incur additional payroll expenses for unemployment tax, the employer portion of FICA, and the employer portion of insurance and retirement contributions. So with that, which of the following items is typically paid by the employer only? Okay, well, I got federal and state income tax. Well, I know the employee pays that. I got I should say employee because employee would go either. Social security tax. Well, I know that's both because those are collectively included in my FICA. I have this unemployment tax. Hey, now I'm getting somewhere. I know only the employer pays that, but I can double check and make sure that this Medicare tax is in fact paid by both, again, collectively known as my FICA. So a couple of other things super quick, just with our other current liabilities. Here we see that deferred revenue kind of rear its head again. And check out what United Airlines, similar to Southwest, check out this notes disclosure that they have. They say that the company presents passenger revenue, cargo revenue, and other operating revenue on its income statement. The passenger revenue is recognized when transportation is provided. Okay. So what that tells me is something about revenue recognition. And that also tells me that I don't get to recognize revenue until that customer takes the flight. So I purchase an airline ticket. Southwest or United is going to recognize my cash of 100. That's a cheap flight. I'm going to Vegas for the weekend. But they're going to have a liability until they actually provide me that flight. Okay. Now, when they do provide the flight, they back out that liability because they're fulfilling their obligation and they get to recognize actual service revenue in my income statement. Okay. So pretty important delineation here because you can buy flights 6 months in advance and we got to make sure we're recognizing revenue in the correct period. Sales tax payable. Now, this is an interesting one because the companies do collect sales tax on behalf of the government. So if you think about going to Walmart or whatever it is in Lincoln, Nebraska here, well, you buy a $100 product. Well, when you go to the cash register, do you pay exactly $100? Well, no, you're probably going to pay about $107 because we have a 7% sales tax in the state of Nebraska. Okay. So the last thing here is the current portion of long-term debt. So that's going to be debt that's paid within 1 year of the balance sheet date. So say you have, or a company has a 30-year lease or a 30-year mortgage. Well, every time, right, that this is now due within the next year, that becomes current. And the rest, right, is long-term. So we have to reclassify this as they become current as the time passes. So we're going to go through each individual example here. We have our deferred revenue. Amazon sells a gift card to a customer for $100 and they record the sale of the gift card as follows. Well, what does Amazon get? They get cash. They get $100. What do they have to do? Well, they got to provide a product to somebody in the future, right? So I get to recognize my cash going up, but I also have an obligation now when somebody uses that gift card to provide you a product. So now, assume Amazon sells a gift card to a customer for $100, right? And let me go ahead and cross this out super quick. Sorry. Let's say, I don't know, a customer buys something. How much do you think this product that they buy for? Let's go $15. Okay. So customer's going to purchase, they're going to purchase something for $15. I'm in the market for some mixing bowls. So I'm going to go purchase some mixing bowls with my gift card that my mom gave me. So now when I actually purchase my mixing bowls, well, I'm backing $15. That's a 15. I'm so sorry. I'm backing $15 off, right? And Amazon gets to recognize the actual sales revenue. Okay. Because they're not obligated to provide me those $15 anymore. They're fulfilling their obligation. Okay. So it's just important to note that there's a difference between these two things, okay? Because I got the cash and I haven't done anything. So I don't get to recognize revenue in my income statement until I actually fulfill my obligation. That's revenue recognition that we talked about in chapter 5. The current portion of long-term debt, okay? Well, the current portion of long-term debt is the amount of debt that's going to be paid within 1 year of the balance sheet date. So that's when I drew this little timeline and I said, hey, I have a 30-year mortgage. The amount that I pay right now, well, that's going to be current. And all these other little ones are going to be long-term because they're over 12 months out from having to be paid. So management needs to know this amount in order to budget the cash flow necessary, right, as this is coming due. So suppose a company has a total long-term note payable of $1 million. So it doesn't ask me for this, but I probably have cash coming in of 1 million and I have a notes payable related to this cash. Okay. So now at the balance sheet date, the company determines that 200,000 of the note is due within the next 12 months. Okay. So I have the balance sheet date, right? December 31st, 2027. And I'm saying of this total 1 million, 200,000 of it is going to be due within the next 12 months. So how do I want to classify that? Short term or long term? Well, I want to say that this note's payable, right, is going to be short term. I'm increasing my short term liabilities by 200,000. But did I actually increase my total liabilities? Well, no, of course not. All I'm doing is backing out the long term portion for the same 200,000 and saying, now this is going to show up in my current liabilities on my balance sheet, and this is going to be reduced from my long term. So what this is going to look like is I'm going to have a short-term note payable of 200,000. I'm going to have a long-term note payable of 800,000. So I'm going to have a total note payable of my 1 million, but it's being split out between these two different current versus long-term. So again, on a balance sheet, you're just going to see this listed separately, right? Because they represent different timelines as when this obligation comes due. So the one thing we haven't talked about yet is a sales tax payable. And in this case, it says a home improvement store sells some merchandise to customers. The price of the merchandise is $200 and a sales tax rate is 6.5%. Okay. So I'm going to book a journal entry super quick and I'm going to say the home improvement store sells some merchandise. So I'm going to have sales revenue as this merchandise store. And the price of the merchandise is $200. So this customer is giving me $200. Okay. But when the customer goes to the cash register, do they only pay $200? Well, no, they give me some sales tax, but I'm not immediately remitting that to the US government. So I hold it in a liability account until I do remit that to the government. Okay. So how much do they owe me in sales tax, or how much do I owe the government in sales tax for this product? Well, it's my 200 times my 6.5%. Well, that gives me $13. So what that means is the customer gives me cash of 213. Okay. So how we need to understand what the question is asking, right? Which is how much would we record in the sales tax payable account, right? Well, that's going to be this $13 because the 213 is the total of revenue plus tax. Okay. 130, don't know where that came from. And none, well, of course, I know I have an obligation to remit this to the US government. Okay. So then they probably remit this on like a quarterly basis or whatever it might be. When they do remit to the government, what you're going to do from a company standpoint is I'm going to back that sales tax payable off. And I'm going to recognize my cash going out the door. So think about the sales tax payable as just a holding account until I actually remit that money to the US government. I'm just collecting it on their behalf by the sales tax that the customers are giving me. Okay. So I'll see you next video for our discussion on contingencies.